Hello, and welcome to another episode of the Market Snapshot series. My name is Rufus Kamau, Markets Analyst at FXPesa. So today, we will be having a good session talking about markets, trying to understand the key market events impacting the various assets that we normally trade. We will also do technical analysis, try and understand the chart patterns, the prevailing price levels, and where markets might be headed next. So once we go through these, hopefully everyone will trade from an informed perspective. So for those who are new, you should know that these sessions happen daily on Monday to Friday at exactly 11 a.m. So before we make any progress, I'd like to begin with a mic test. So if you can hear me clearly, kindly type hello on the live comment section, and these should confirm that everything is working just fine. Hello, Nzomo. Hello, Richie and Billy. Thank you, guys. Thank you for your responses. I appreciate this. Let's keep things going. So hello, Mana Basto. Hello, Molenga. Good morning. So today, as we all know, being Tuesday, the 30th of January, just one day before the end of the month, we are looking to focus on what's basically impacting markets. And once we understand it, then we'll be able to process that information into actionable intel. So as usual, this is not investment advice, neither is it a recommendation to trade. So you should always do your own research and practice proper risk management. So hello, Emerald Schools. I can see Rosalie in the house. Victor, thank you guys for joining. Peter and Francis. Victor, hello, welcome to the session. So let's get these things going. So I would like to begin with an update that I made earlier on my Twitter or X account. And this is concerning the key market developments that we are expecting today. So the first one, and I think this is really important for any investor who is focused on real estate, we will be getting the S&P Case-Shiller Composite Housing Price Index, and these will be coming in at 5 p.m. East African time. So after hitting an 11-year low in July last year, the index has had 5 consecutive gains and is expected to have gained by 5.8% year over year in December 2023. So investors in US real estate will be focused on this data to understand the key market trends. So on the other hand, for us, the Forex traders, we always try to understand if there's an event, how does that event affect the markets or influence the markets? And once we understand the impact on the markets, then once the data is released, we're able to tell the impact on the markets. So looking at 5 p.m., I'm trying to scroll through this calendar. Notice that the Case-Shiller Housing Price Index was last reported at 4.9%. So what I want to illustrate is that this industry was contracting, went to negative 1.6 and then negative 1.7% before it started increasing. So we have had 5 consecutive months since July last year, where the Case-Shiller Housing Composite Index has been increasing to 0.1, 2.2, 3.9, and 4.9. Of course, for today, we have a positive expectation that housing prices improved in the US within the month of December. So if we go to our economic calendar, majorly Forex Factory, then we click on calendar, see the events for the entire week. Then you'll notice that the previous reading was 4.9%, and in this case, the expectation is 5.8%. So the way we have been processing this data is by following the Fed, or basically the Federal Reserve Bank of the US, which is basically the central bank of the US. So in this data, we know that the Fed is looking to tighten policy, and this has been the case for the last 18 months. And the Fed has been majorly focused on several key factors within the economy. So it has been majorly focused on inflation to get it back to the 2% target. So as a result, it went for rate hikes, which interest rates from around 0.1% to the current upper level of 5.5%. So with interest rates at 5.5%, the Fed is confident that this is restrictive enough to ensure that the economy is tightening and that inflation gets back to the 2% target. So the key indicators that the Fed has been observing within the economy has been in several industries in trying to make sure that the US economy slows down significantly. So one of the key indicators is the job market. And we know that we are getting a job market report on Friday, which will be the US non-farm payrolls. So US non-farm payrolls will be very important this week. We expect a lot of activity in the US dollar after the announcement of the non-farm payrolls on Friday at 4:30 p.m. But then inflation data came in 2 weeks ago, where inflation jumped higher to 3.4%. And last week, we had the core PCE price index, which was still significantly higher than expected at 2.6%. So now we focus on real estate because the Fed has been looking to slow down real estate. So whenever real estate is hot, prices are moving high. In that case, it attracts a lot of investors into the real estate sector. And as a result, we see more money flowing in the system rather than out, and this tends to be inflationary. So a higher housing price index is inconsistent with the Fed's expectations and might lead to the Fed holding interest rates higher for longer, which is very positive for the dollar. So as we wait for the data, if we see a housing price index that is around 5.8% or even higher, then that should be positive for the dollar because the Fed may have to hold rates higher for longer. So on the other hand, if the housing prices are cooling off from the previous reading of 4.9%, then in that case, we should be expecting to see a much weaker dollar because the Fed will be confident to go ahead and implement the projected rate cuts. So that's the analysis for the S&P Case-Shiller Composite 20 Housing Price Index. So later on, we'll be having CB consumer confidence data. So when consumer confidence is strong, it means that people have more money in their pockets, their businesses are doing well, their jobs are stable, and as a result, they tend to buy more stuff with the economy, borrow more, and so on. And as a result, we tend to see inflationary pressure. So the Fed's expectation is that we continue seeing consumer confidence weakening, and as a result, it would be closer to its target of getting inflation back to the 2% target. So the same case that has applied to the housing price index also applies to the consumer confidence survey. So if confidence is strong and to the upside, then this tends to have a negative impact because the Fed will basically be holding interest rates higher for longer, and that is quite positive for the dollar. Interest rates remaining higher is positive for the dollar. So as for job openings, this is advertisements for new jobs. And this data is a leading indicator of the job market trends. So when the economy has more job openings, it means that employers are expanding production, distribution, and so on. And as a result, it shows signs of an increasingly strong US economy. So when job openings are weakening, then it shows, so when job openings are lower, it means that the economy is slowing down. So as I already mentioned, the Fed is looking to slow down the economy. So weaker job openings will be consistent with the Fed, and that's negative for the dollar. But then strong job openings tend against the expectations of the Fed. And as a result, the Fed might have to hold rates higher for longer. And in that case, we could be seeing a much stronger dollar. So in summary, if all the 3 data points are extremely positive, or 2 out of 3 are positive, then should be positive for the dollar. And if, let's say, we see all of them weakening, then that should be negative for the dollar. And let's say 2 out of 3 tend to be performing poorly, then as a result, it should be negative for the dollar. So I'm hoping that's a good summary for what we're expecting later in the day, the CB Consumer Confidence Survey, as well as the JOLTS job openings. So tomorrow morning, we'll be having Bank of Japan summary of opinions. This is way early before the next market snapshot at 11 a.m. So we'll also be getting preliminary industrial production data as well as sales data from Japan. So we expect a lot of volatility from Japanese yen pairs in the morning around 50 a.m. So then we will also having the consumer price index, is a measure of inflation in Australia. This will be released at 3:30 a.m., where inflation is expected to have slowed down to 3.7%, down from 4.3% in the previous month. So this is also expected, this is from the previous quarter. So it's also expected to bring in some much needed volatility in Australian dollar pairs. Then at 4:30 a.m., we'll be looking at manufacturing PMI as well as a non-manufacturing PMI for China at 4:30 a.m. So you can choose to trade USD CNY, or you can choose to trade oil. Remember, China is a big manufacturer. So manufacturing trends in China tend to have a direct angle on oil prices. So strong manufacturing means strong demand for oil, and as a result, oil prices tend to go higher. But then if manufacturing is weak, then that tends to be also weak for demand for oil, and it means much weaker oil prices. So we'll also be looking at the German as well as European preliminary CPI, and this will be happening around 10 a.m. before we get to the next market snapshot, which will be presented by Norbert Kiza from Kampala at 11 a.m. tomorrow. So I will not be covering the rest of the data because that will be sufficiently covered by Norbert tomorrow. So early this morning, we had some data coming in from Japan, and this is regarding the job market. So the unemployment rate improved to 2.4%. So the lower the unemployment goes, the better for the economy. But then digging deeper into the data, there was quite a number of worrying things. But then at the same time, the Japanese yen strengthened as a result of the data. So what we saw in the data was pretty simple. Japan's unemployment rate fell to 2.4% in December, down from 2.5% in the previous month, which was the consensus forecast. So the data came in as expected. So it was the lowest jobless rate since January 2023, as the number of employed persons increased by 380,000 to 67.54 million, while the unemployed declined by 20,000 to 1.56 million. Meanwhile, the jobs to applications ratio stood at 1.27 in December, indicating that there was 127 job openings for every 100 job seekers. So when you really think about this, that companies are advertising 127 jobs for every 100 job seekers, means that the economy is growing fast and it's more than capable to accommodate new job seekers. In fact, it indicates a very tight labor market where there's more employers looking for employees than employees looking for jobs. So as a result, we saw the Japanese yen strengthening as investors bet that demand for goods in Japan would also increase the demand for the Japanese yen, and as a result, strengthen the JPY. So those are the key highlights for the day. Of course, on the political side, we have quite a number of things developing. One, yesterday, it was on Monday, the 29th of January, 3 US soldiers were killed and 40 others injured at a military outpost in Jordan. And this was after a drone attacked the military site. So the drone is suspected to have come from Iran-backed militants. And there has been increased pressure on Joe Biden to give a response. And the markets have been trying to price in a potential that Joe Biden would respond with big strike on Iran. So if there was to be a big strike on Iran, then this would spark a huge war and further destabilize the Middle East region. And as a result, investors are very concerned, and this could have an impact in the markets. So besides that, on the earnings front, we have two big companies. So if you've heard of the Magnificent Seven, two of the Magnificent Seven companies will be reporting earnings today, and these will be after market close, which is 11 p.m. East African time. So I remember last week we discussed NVIDIA as well as Tesla, which are also part of the Magnificent Seven, where NVIDIA did, sorry, not NVIDIA, but Netflix. So Netflix did very well, but Tesla missed expectations. And now we are looking at two more companies in the Magnificent Seven in an attempt to understand whether the AI frenzy that drove stocks last year has died out, or whether it has had a material advantage for these stocks, whether it's reflecting in their books. So Google, as well as Microsoft, will be reporting, and the two companies have a combined valuation of $5 trillion, with Microsoft being having a valuation of slightly over $3 trillion, and Google slightly under $2 trillion. So when you combine them together, you have about $5 trillion, and investors will be trying to understand the valuation of these companies, see whether they are overbought or whether the valuation makes sense according to their books. So lastly, Fidelity Bitcoin ETF demand eclipsed Grayscale investments outflows on Monday after pulling in $208 million versus the outflows of $192 million coming in from Grayscale. So in recent days, we have seen that Bitcoin prices have been plummeting, basically going down as a result of the big sales that were being made by Grayscale. But then I don't think the concern is there anymore, because Fidelity Bitcoin ETF is buying at a higher rate than the amount of money that Grayscale is selling. So the outflows coming in from Grayscale are no longer hitting the market prices of Bitcoin, because Fidelity is absorbing that supply. And in fact, it's having a higher amount. So with yesterday having 208 million purchases compared to 192 million sales. So Bitcoin has rallied 3%, that was on Monday, to 43,203, which was the closing price. And as we continue trading, we should be expecting to see further gain in momentum as Grayscale's outflows continue reducing. So that's it for the day. That's the highlights for the day. And now, as we look at the charts, we try to understand the key developments. I'll be starting with the dollar index, which has been pretty sideways. So we had this momentum downwards and then upwards. And now it's time to adjust our charts, remove these. So we have been seeing out of ranging price activity in the dollar index. But then what we are seeing here is a market that is now forming what looks like a diamond. So in a diamond formation, the lower trend line changes. So the market stops forming lower lows and then changes higher lows. But then when you look at the highs, the market also changes in a similar manner, where it swaps from forming what we call higher highs and then gets into lower highs. So this is the diamond formation. It may not be perfect, but you have a clear idea. So low volatility, high volatility, low volatility, and then the next cycle is expected to be a high volatility cycle, which may imply strong momentum. So the attempt to break higher yesterday was met with selling pressure. So eventually the dollar index plummeted back down at the diamond, but then it has found good support and would be expected to see a strong rally coming in after the market tested this trend line and now bounced off strongly from that point. So the reasonable expectation for the day is that the dollar index continues dominating the bullish momentum today. So remember, this comes ahead of the FOMC press conference that is expected tomorrow at 10 p.m., where the Fed is expected to hold interest rates at the current level of between 5.25% and 5.50%. So when you look at the charts and try to understand using the CME FedWatch tool, then you'll notice that for the meeting on 31st, which is tomorrow, there is a 97.9% probability that the Fed will hold interest rates at the current rate, which is 5.25% to 5.50%. So investors are not concerned about tomorrow's decision. They are concerned about the guidance for the next meeting, which will be on the 20th of March as we approach the end of the first quarter. So the probabilities have been shifting based on the data we have been receiving in the markets, where at the beginning of the year, this was above 70%, and now it has dropped down to 46.6%. And this was the probability of a 25 basis point cut in the March meeting to 5.25%. So now there's over 50% probability that the Fed will hold rates higher for longer, and this is being priced at 52.4% probability. So seeing the market reacting this way basically implies that the Fed may hold rates higher for longer, and the overall expectation is that if rates stay higher for longer, then we continue seeing a much stronger dollar in the market. So judging from the last couple of weeks, from the beginning of the year, you can see the progression of the dollar moving higher and higher. And as a result, there's key trends emerging in other pairs. So for instance, for USDJPY, the dollar has been gaining against the yen. So we had this diamond formation being formed here. Eventually, the market managed to break below the trend line and consistently moved further downwards. And you can see the area where the market eventually got support is an area where the market has found support before. This instance, and then now. So as a result, we are seeing the dollar index starting the London session on a strong foot. And the current candlestick is evidence of buyers coming in and pushing the dollar higher against the Japanese yen. So despite the weaknesses we had seen in the Japanese yen, especially during both the Sydney and the Tokyo sessions, what we are seeing is a strengthening of the dollar against the yen. This could be the story for the day. So even on the forward chart, you can see the reversal is starting to shape up. And now there's expectation that we continue seeing higher prices. So for USDJPY traders, I think as we approach the open of the day, remember all the losses we had seen in earlier sessions have been erased with this one candlestick. And now the next target becomes yesterday's high, which is quite significantly higher. So we could be seeing the dollar making a strong rally and getting to 148.320 after bouncing from this point. So 148.320 is all the way up. So if you have any questions or comments, feel free to type that in the live comment section, and I'll be responding to that shortly. So for EURUSD, what we are seeing is a continuous bearish momentum discussed this yesterday. So after the market opened the gap, it wasn't able to close the gap fully. Then there was a big sell-off before the euro recovered later in the day. But then what we are seeing overall here, the market that has remained significantly weak. And if I was to zoom out, eliminate all my area lines, then you can see that something is beginning to shape up along these lines. So this has been the story of EURUSD, facing some good resistance for the last 5 sessions. And now, after the market has retested this trend line, there is that possibility that the market keeps pushing downwards, and now the new target becomes yesterday's low. So there's this expectation that the euro continues losing to the dollar, and we get to 1.07953. So for the other assets, I'll be a little bit faster. So for pound USD, you can see that the market is now forming lower highs. And now, after the strong momentum yesterday in the evening, the market has now started reversing. And now the target becomes yesterday's low, which is somewhere around this area, 1.26616. So potential possibility that the market drops to that area. So we remove our area projection for the breakout, and now we expect the market to at least retest yesterday's low. So for USD CAD, we've seen the Canadian dollar being pretty strong as a result of strong oil prices. Then now it seems that the market was unable to accelerate after hitting the support. So the support had held twice, but then now we are seeing a lot of movements here where the market is neither going up or down, which basically implies some consolidation. And now there's this expectation that the market now bounces here, especially if the dollar was to strengthen across board from this point on. So if the dollar strengthens across board, then the overall expectation is that it rallies against the Canadian dollar and gets at least to yesterday's high. So as for gold, we have talked about the attack on the US military station. So as a result, we have seen gold breaking this trend line. And this is a trend line that started around the 20th of December last year. So for the better part of this year, that is in January, market has been unable to cross this trend line. The last time, we are seeing the market cross this trend line convincingly. Notice how we analyze that the market would get to this area and then reverse. It's already happened yesterday. Market got to $2,037 per ounce of gold and then sold immediately. But then now, with the geopolitical concerns, investors are increasingly taking the safe haven route. And the safe haven route means selling risky assets, going for much more safer assets such as gold. And the rally is pretty clear. So normally, know that if our market breaks a pattern, the usual targets are often the top of the pattern. So I'm not crazy. I don't expect gold all the way up and get to 2089. But then an interesting area to be observed and to work with as a target be the $2,061 per ounce of gold. So this is reasonably the mid-January high. So in this case, I expect gold to rally to that point. So as for Australian dollar trading against the USD, it has remained within this range. So nothing has changed so far. So every time the market gets the upper trend line, gets rejected, moves downwards. And once it gets the lower trend line, gets rejected and moves upwards. So nothing has changed. And now you're getting this acceleration here. So as the dollar strengthens, it strengthens against the Australian dollar. So the overall expectation is that this market keeps going downwards and perhaps tests this basic support. So US equity indices managed to make a breakout. After forming this flag, the breakout happened yesterday. The market is yet to hit last week's high. But then there's a very strong expectation that the market will hit last week's high, continue moving that way. So in this case, we are expecting to see yet another leg as the Nasdaq attempts to form another all-time high. So remember the price that we see as the highest price here last week was an all-time high on the Nasdaq, and now it's attempting to go back to the same point. So the bearish momentum is not that strong. The candlesticks that were going downwards are pretty weak. And now you can see bullishness resuming in the markets. So for the day, I would be very bullish for the Nasdaq. So for the Dow, we saw another all-time high yesterday. So I expect this to continue. So from the daily chart, you can see it has been a pretty strong momentum since around October last year. And I expect this momentum to continue today in correlation with the Nasdaq as well as the S&P 500. So yesterday we also had the breakout here, and the S&P 500 formed another all-time high. So even if you go to the daily and weekly charts, you can see that the market has not been here before. So from the daily chart, we counted this number of candlesticks here, and you can see 1, 2, 3, 4, 5, 6, 7, 8. So for 8 straight sessions, it's only one that the Nasdaq lost slightly, but then the bullish momentum is clearly evident. So I expect to see a continuation of the same. So after the early morning trading and an attempt to move downwards, bullishness has resumed, and S&P 500 is to scale higher and form another all-time high. So as for oil markets, there has been worries, but then we have had a very nice chart pattern here. So after forming this triangle, the market managed to break here last week, narrowed to the base of the pattern here. This was our target, $83.677. Then there was a lot of selling immediately after that. So yesterday, as we were analyzing the markets, we saw that there was the potential for the market changing direction. And from then, you can see it played out as expected. And now oil prices are tempting down even lower. So, well, from the technical analysis perspective, it seems very reasonable go for short selling positions. You should be aware and, of course, concerned about the developments happening in the Middle East. So we would be seeing, yes, the market dropping, which is the reasonable expectations anyway. But the market will drop to 80 $0.325 per barrel. But then the idea is to keep looking for bullish positions, because a destabilization of the Middle East region would potentially lead to tighter supply in the market, and as a result, bullish momentum for prices. So European equity indices have also managed to maintain a strong bullish momentum. So expect to see similar correlation with the SP 500, the Nasdaq, and the Dow. So same case for the Euro stocks as well as the UK FTSE 100 index. So for the FTSE, we saw the market hit this major resistance, play around there for a day, break higher, retest, and now we are seeing the market bouncing off slightly. And as a result, there's the expectation that the market will now complete the journey and get to 7,755 price level. So lastly, Bitcoin. We managed to analyze this area here and say that we expect a break of this trend line. Once it happens, we continue trading higher. So from the forward chart, this is how it looks like. So after the market broke towards the lower side, retested, broke even lower, got back to the trend line and got inside. Now the expectation is that the next resistance is around 46,200. So there's this overall expectation that Bitcoin makes a rally from this point onwards and gets to this price level. So that's it for the day. Let's see if there's any questions that I may have missed. Oh, interesting. So there's no question so far in the markets here from the people listening live. So hello, Victor. I can see Peter Samuel, Francis Gashago, and Nixon Kasembeli. Hello, guys. So as we approach the end of the presentation, I would like to make two announcements. So the first announcement is that the last week's Bullish Banter podcast was out about 4 days ago, where me and Samson Mzera, we covered the bullish forecast for central banks, inflation, as well as global economies. So in this episode, we dig deeper into the Bank of Japan, its policies. We look at the Federal Reserve Bank of the US, the European Central Bank, the Bank of England, and try to understand the key policy decisions that they are about to make this year and the potential directions that the currencies, their respective currencies, might take. So this will be pretty important for you. If you enjoy the podcast, always feel free to like podcast, share, so that other people can reach and understand it. Then a new episode is also coming out later today. So be on the lookout. We'll be releasing yet another podcast episode for the day. And as we all know, it's weekly and we release on Wednesdays. Besides these, we have yet another announcement to make. And this is the FXPesa Quarter 1 Economic Outlook. So this one is already out. So I will be sharing the link in the comment section. But whenever you have time, go through it. And once you understand it, you'll be more equipped to approach the market better than any other trader who has not gone through the report. So there's a lot of intel coming in from the various analysts that are involved in the economic outlook report. And this spans our global team. So you'll notice that there's different analysts presenting different concepts and topics, ranging from Farah Murad, who is our senior market analyst. Trying to scroll here. We have Raid Al-Kadir. This will be the chief market analyst for equity, which is the bigger firm owning FXPesa or AGM securities. We'll have more analyses coming in from Raid. Then later on, there's Nadia El-Bilasi, markets analyst still with equity. We'll also be getting more content from Ahmed Azam, our regional financial market analyst. Then we have our UK market analyst also presenting their views about Q1. This should be Stuart Cole, our chief macroeconomist. And of course, the one and only, I will also be sharing my own projections for Q1. So I will be showing you this section, just a quick skim through so that you know what you're going into. So besides Stuart Call, my machine is a little bit slow on the scroll. Yeah, this is a focus on China's EV industry, which is accelerating growth from Rufus Kamau. So thank you very much, guys. Thank you for your time, and I hope to see you on the next one. I'm really sorry I wasn't sharing that, but this is it. So this is the report. But I've already shared the link to the report on the live comment section. So thank you, guys. See you then.